This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the beginning of our study of corporation tax in the previous chapter, I gave you three terms that needed to be defined. Three terms that would then underpin the preparation of the corporation tax computation. Now, what were they? They were, to begin with, the period of account, which was simply the period for which the company prepared its accounts, its statement of profit or loss. Secondly, the accounting period. Now that was the critical one for us. That's the period for which we prepare the corporation tax computation. And thirdly, the term the financial year. The financial year, as we know, runs from 1st of April to the following 31st of March, and is denoted by reference to the year in which it starts. What is its purpose? To set the rate of corporation tax for that period, for that financial year. So that brings us back to the first two. The period of account, simply the period for which the statement of profit or loss is prepared by the company. And that is what you're given in the exam question. If this is a Section C examination question with the requirement to prepare the corporation tax computation and compute the corporation tax liability, what they give you in the question is the statement of profit or loss. And from it, we then need to prepare our corporation tax computation for an accounting period. Now, so long as the period of account does not exceed 12 months, so it is the company's accounting year end, or it may be a short period of anything less than 12 months, as long as it doesn't exceed 12 months, the period of account becomes the accounting period. We prepare one corporate tax computation for that period. But if as here we have a long period of account, one of more than 12 months, then we are going to be required to split that long period of account into two separate corporate tax computations, two separate accounting periods. The reason being, corporation tax computation cannot exceed a period of 12 months. So if we prepared accounts for, say, a 15-month or an 18-month period, then we have to divide into two computations. The first of which, however longer the period of account may be, is 12 months. And then the second is the balance of the remaining months. So a 15-month period becomes a 12-month accounting period and a 3-month accounting period. The 18-month period of account becomes a 12-month accounting period and then a 6-month accounting period. So in this chapter, very short chapter thankfully, the shortest one that we've got to deal with in the entire study notes, but we need to see how it is from one statement of profit or loss we now prepare not one but two separate corporate tax computations. And that first point made here, if we have a period of account longer than 12 months, we've got to break it into two accounting periods, they always being the first 12 months, then the remaining months. On a 15-month period, you cannot go 3-12. It must be and is 12 months followed by the remaining 3 months there. So we're going to have to start the process by, as is, we said, given in the question, looking at our statement of profit or loss and doing the same things as we've done before, but now potentially breaking those items into these two computations. So the first exercise is still the adjustment of the trading profit, but we'll note before the deduction of capital allowances. So you've got a statement of profit or loss for a 15-month or an 18-month period there. It is still one single adjustment of profit for that entire 15-month or 18-month period. We do the same things as we've done before. There are expenses that are on that statement of profit or loss that have been debited thereon, and they're not allowable for taxation. So we need to add them back, or some part of an expense item needs to be added back. Our favourite, of course, being depreciation, but it is replaced, we'll talk about separately in a moment, with our capital allowances for the accounting period concerned. But we'll do our adjustment of profits, adding back non-allowable expenses and taking out, of course, any item credited that is not trading income. And those will be dealt with separately. So if we've got now an adjusted profit for, say, an 18-month period, what do we do with it? Because that one period of account becomes two separate computations. And on your working and on your presentation for a Section C answer, you'd have two columns being the first period, the 12 months to, whatever it might be, and if it's an 18-month period of account, next to it, the 6-month accounting period. 12 months to, 6 months to. So what do we now do? We simply time a portion. What is the adjusted trading profit of that 18-month period? So, of course, what we would have here would be 12 eighteenths there for our 18-month period, and 6 eighteenths for the second accounting period. We would simply split out that long period of accounts, adjusted trading profit. Here we're suggesting for an 18-month period, 12 eighteenths, 6 eighteenths. It's deemed to have accrued evenly over that 18-month period. 12 eighteenths, 6 eighteenths. We don't try to separately work out what profit was actually made in the first 12 months, what was actually made then in the next 6 months. If you wanted to do that, then you would have prepared two separate sets of accounts. You'd have gone with a 12-month period, using your normal accounting year-end date until that point in time, and then moved to your new accounting date by preparing a short period of account, one for 6 months, a 6-month statement of profit or loss. But if you have decided to do it via one long period of account, then adjust up the profit for the 18-month period, as we've said here, and then assume that that profit is accrued evenly, taking 12 eighteenths and 6 eighteenths of it, respectively, to each of the two accounting periods. So it's all the same work as before, but then time apportion that adjusted profit between the two separate accounting periods. And in the Section C answer, you'll record your corporate tax computations here in columnar form, with the two columns, one for the 12-month period and one, of course, for the balance of the period, here 6 months. Now, we've done that for the adjustment of profit, but before deduction of capital allowances. Because when it comes to capital allowances, we do not prepare, in corporate tax here, we do not prepare a capital allowance computation for the period of account. Instead, we prepare now separate capital allowance computations for each accounting period. So there will be a capital allowances computation for that 12-month period, and then a separate capital allowance computation, carry forward your balances on any main pool, any special rate pool there that you may have, or indeed any short life asset that you might have. And they will be brought forward at the start of the 6-month period, and you then have a separate capital allowances computation there. So the first exercise you've got to do, given that you'd have a list of expenditure, capital expenditure on plant and machinery, you would have to allocate the expenditure and, if necessary, the disposals to the two separate accounting periods. So what transactions here, purchases and sales of any assets, what took place in the 12-month period and what took place in the 6-month period. Here we are allocating those capital transactions to each accounting period. Now, the first capital allowance computation is for a 12-month period. So it's a normal annual period. So your annual writing down allowance, your annual AIA limit there will apply. But that, of course, is not going to be the case when it comes to the short period. Here, in our example, the 6-month period that we have. In this 6-month period, then we have to realise that both WDA and AIA will be restricted in the second short period. So we would have, in the second short period of 6 months, we'd have 6/12 of the annual writing down allowances being available to us, and we'd have 6/12 of the AIA limit based on £1 million for a 12-month period. So half of that for the 6-month period would be a £500,000 AIA limit. So WDA, AIA will be time apportioned. But of course, as we saw when looking at this issue in dealing with the unincorporated trader and the preparation of our capital allowance computations, we know that if we have a short period for the CA comp, then we must time apportion WDA and AIA limit. We do not time apportion our first year allowances. Note that FYAs are never restricted for short accounting periods. So any first year allowances, whether they're now the special, the super deduction, the 130% first year allowance, or as it was for the unincorporated trader, the zero emission cars attracting a first year allowance of 100%, they are totally unaffected by the length of the accounting period. It's a one-off first year allowance, either 130% of the expenditure incurred or 100% if it was a zero emission car. So two separate computations. You then take, of course, your capital allowances for each period from your time apportioned trading profit for each period and have a tax adjusted trading profit or potentially loss, but I think in the exam question it would be a profit there. You'd have your tax adjusted trading profit for each of the two separate accounting periods. But of course there may be other forms of income that then need to also be included as part of your TTP, your taxable total profit. We might have property income. We might have interest income. And both property income and interest income here we include, as we've always done, on an accruals basis. So what income accrued in the 12-month period, what income accrued for the 6-month period. Doesn't matter when it was received there. All that matters is what was, again, accrued for the 12-month and the 6-month period. We use that accruals basis as we've always done. But you need to divide there between those two periods. We might have a deduction from the total of all income, of course, our total profits. We might have a qualifying charitable donation, which would be based on the date of payment. But before we got to that deduction of total profits, we'd need to include chargeable gains. So we now allocate. We're going to allocate donations as to what was paid in the 12-month period, what was paid in the 6-month period. With the chargeable gains, what was the date of disposal? What was disposed of in the 12-month period? The capital gains are allocated to that first accounting period. What was disposed of in that second accounting period, that 6-month period? We allocate those disposals and any capital gains that arose thereon to that period. Quite commonly what we might see here for an exam question to test you out on the capital gains issues for companies, which of course all the detail of that is forthcoming in the later chapters here. We've dealt with CGT for individuals, but we've got separate chapters for capital gains in corporate tax. So what we would have to look for is what, again, like with the plant and machinery, what was bought and sold in each accounting period. Now in relation to capital gains, what was sold in each accounting period. As I say, in the first 12 months, allocate to the first period. In the second 6 months there, allocate to that period. What you might find is that over the 18-month period, you've had two disposals. One in the first accounting period, one in the second accounting period. And the one in the first period might be a capital loss. Now, if you have a capital loss, all you can do with it is to carry it forward to set off against your future chargeable gains. So when you do the corporate tax computation for the first accounting period, there's nil for capital gains. We don't put a bracketed capital loss into our corporate tax computation. Instead there, it's carried forward. So in the second period, you'd show a working for that chargeable gains figure to include on the corporate tax computation. It would be the capital gain made on the disposal in that period, less the capital loss brought forward from the previous 12-month period. So it tests you out. Not just can you compute a capital loss, can you compute a capital gain, can you allocate these transactions to the separate accounting periods, can you also recognise that if there is a capital loss on its own or a net capital loss for an accounting period, that net capital loss will then be carried forward to set off against future chargeable gains. And that's what you might have in that second here 6-month period. But again, the details of capital gains under the corporate tax rules, that's coming up from chapter 19 onwards for 2 or 3 chapters there. So more of that later. Now, dividends, of course, this is not taxable income, but we may need dividend income to work out our profit, to know whether or not the company was large, and what is the purpose of that, to know whether or not any quarterly instalment payments are going to be required to be paid by the large company, the detail of which again is shown in chapter 23, I think it is, the admin for corporate tax. So we would need to know how to allocate dividends to each accounting purposes, allocate dividends for taxation purposes, I should say, to each accounting period, in order that for each period we could add in as necessary the dividend income to the taxable total profit to give us profits, and then compare those profits with your relevant limit. And that limit, of course, as we know, is 1.5 million, but remember that's based on a 12-month accounting period. So in the second accounting period, it too would need to be time apportioned to know whether or not you were large. It makes no difference to the calculation of the corporation tax. What it makes a difference to, of course, is when you have to pay that corporation tax. But again, more of that in chapter 23. How do we allocate dividends? Based on the date received. So all of the content of the corporate tax computation, in terms of income, in terms of outgoings, we now have a way of taking from one statement of profit or loss and putting the content of that into 2 separate corporation tax computations. So all we need to do now is to test out our newfound knowledge in terms of example 1. So what are we going to do? Calculate the corporation tax liabilities for the relevant accounting periods here. And we're quickly told that A plc prepared accounts for a 15-month period to the 30th of June 22. So as you read this in the question, you recognise this is a long period of account. I'm now therefore going to need 2 separate corporation tax computations, and a 15-month period is going to be split 12 months and 3 months. Now, it was for a 15-month period to the 30th of June 2022 there. So it would have begun 15 months earlier, and that would take you through to what the 1st of April of 2021. The 1st of April 2021. So the first 12 months will be the 12 months through to the 31st of March 22. The second period, the 3 months to the 30th of June 22, the end of that long period of account. So we now know the 2 periods for which the corporate tax computations are required. The 12 months to end of March 22, and then the 3 months to the end of June 22. And what do we have? We are given here the adjusted trading profit at £4 million. Now, of course, that figure you may have to work out for yourself. You may, and probably would, certainly would, in a section C question, be given the statement of profit or loss, and you would have to do your adjustment of profits for that period. Here, a 15-month period. So this is telling you, this adjusted profit, we've done that for you. We've added back the non-allowable expenses. We've taken out of the profit any non-trading income there. What this is just the adjusted profit, not the tax-adjusted trading income figure, because we're going to separately deal with capital allowances. So we've got 4 million, and we know that is going to be time apportioned. It's a 15-month period, so 12/15 and 3/15 respectively there for the £4 million. The chargeable gain that was made, sale of asset, we look at the date of disposal, the 6th of May 22. Well, into which period does that belong? It doesn't fall in the 12 months to March 22, so that 80,000 is allocated to the second short period. The qualifying charitable donations paid annually on the 31st of July. Well, in the 15 months from the 1st of April 21 to the 30th of June 22, there's only one 31st of July, and that will be the 31st of July 21, and that falls in that first period there. So that deduction, the 20,000, the qualifying charitable donation, will be deducted in deriving your TTP in the 12-month period. That's where it will be deducted. You're going to have to also do here the separate capital allowances computations, and again, plural computations. One for the 12 months to March, the other the 3 months to June 22. So what are we given here? We've got, of course, any tax written down values brought forward. What would they be brought forward on? Most likely the main pool, possibly main pool and or special rate pool. Less likely, of course, is if we've got a short life asset. But here, tax written down value of plant and machinery qualifying for capital allowances at the 1st of April 21 was nil. So there's no tax written down values brought forward. Again, you would be told if there are, and it would specify main pool or special rate pool, or again short life asset. So those figures would be given to you. We don't have any of them here. But we do have capital transactions in plant and machinery during that 15-month period, which we, or rather you, are going to have to allocate to each such accounting period. So with the purchase of, now then, second-hand, not new, second-hand vans for 68,000 on the 12th of May 21. Which accounting period does that date fall into? And new plant and machinery costing £200,000 on April the 14th, 2022. Which accounting period does that fall into? And in addition, long life assets, not just your communal garden plant and machinery, but long life assets here costing £310,000 were purchased on the 1st of June 22. So which accounting period does that fall into? So you can allocate those purchases, and if you were given disposals, you would allocate those as well to each accounting period here. You should be able to do that. You will then prepare two separate capital allowance computations, the first for 12 months, the second for 3 months. So remember, in that 3-month period, then, if there were any WDA would need to be time apportioned to 3/12 of the annual figure, and the AIA limit of 1 million would also need to be time apportioned, taking 3/12 of it. You must also look very carefully at what it is that has been purchased. Second-hand vans for 68,000. So what would that 68,000 rank for in terms of the available capital allowances? Then the new plant and machinery costing 200,000. What special allowance would be available there? And then long life asset. What type of asset is it? And we've got £310,000 being incurred on the 1st of June 22. Okay, so over to you therefore. Set up in columnar form the two columns for the two accounting periods on the right-hand side of your page. Introduce it with the title, the Corporation Tax Computations for the Accounting Periods, and that is 12 months to March 22, 3 months to June 22 there. First up would be your adjusted trading profit, not the tax-adjusted trading profit. We'll need to get the capital allowances there. But you'll be able to take that adjusted profit and as we've said, 12/15 and 3/15. You can then, if you like, leave a gap to begin with for the deduction of capital allowances, before then allocating that chargeable gain. We know to which period. That deduction there of the qualifying charitable donation, we know which period that will go to. So that then leaves you one exercise to perform, the capital allowance computations for each accounting period. That's a separate working. Once you have the figure for each accounting period, then you can come back to this corporate tax computation that you've set up, and away from the adjusted trading profits of each period, take the respective capital allowances. That will therefore allow you to get what is the tax adjusted trading income figure, add in the gain, take out the donations in the relevant accounting periods, get your TTP, and calculate your corporation tax accordingly. So I'll leave you to do that now, then I'll join you again at the end of that exercise to talk you through the answer in the back. Okay, well, let's see how we got on, therefore, with splitting our long period of account into these two separate accounting periods. Again, as soon as you read that length of the period for the statement of profit or loss, you knew that you're going to split it into two corporate tax computations, the 12 months to 31st of March of 2022, and then the remaining balance of months, the 3 months to the 30th of June 22. We know that the adjusted trading profit, prior to the deduction of capital allowances, that is simply simply time apportioned, and that being out of the 15-month period, 12/15 and 3/15 respectively, which all being well is the numbers that we see there, some 3.2 million and £800,000 respectively. I'll come back to the capital allowances because that needs a separate working, of course, here. That would then give us the tax adjusted trading profit. But we did know that we'd allocated the capital gain according to the date of disposal. That went in the second short period. To the qualifying charitable donation, the payment made there, to the first such period of 12 months. And that would give us the taxable total profits to be taxed at 19%. So there's only one missing figure for each of the computations, and that's the capital allowances. For that, of course, we need working one. And here, well, I'll call it working one now, we have our capital allowance computations. These, as we said, are prepared for the separate accounting periods. So we've got here the 12 months to March 22. There's one transaction, the purchase of the vans that took place within that accounting period. Now, they are vans. They're not cars, they're vans. And vans, lorries, trucks, they're the commercial vehicles. They will rank for AIA. They would also have ranked for the 130% super deduction, but for one problem. And what was that problem? They weren't new. They were second-hand. So because they're second-hand and not new, we don't get the 130% super deduction, but what we do get is our normal AIA, 100% of, and obviously £68,000 there is not a problem in terms of an AIA limit of £1 million. Again, the vans purchased were not new, therefore there's no 130% FYA claim available, but we do get the claim for AIA. £68,000, again, well within the £1 million limit. So that is allocated, of course, to the first such period. In it goes, take it away from the tax, or from the adjusted trading profit to give you the tax adjusted trading profit. More interesting is always this second period. Here, the 3 months to June 22. It's a 3-month period. Therefore, any writing down allowances, if they were available, that would be 3/12 of the annual figure. And of course, importantly here, in terms of your AIA limit, what was the 1 million, of course, for the 12-month period is now only 3/12 of that, so £250,000. So what's going to happen with what we bought this period? Obviously, given that we had 100% AIA in the previous period, there was no tax written down value brought forward at the beginning of that period, and equally there was no tax written down value carried forward at the end of that period. So we've got our normal qualifying plant and machinery, £200,000, which of course ranks now for the 130% first year allowance. And that gives us 260,000. We've then got the long life assets that were bought. Long life assets are special rate pool expenditure. But that special rate pool expenditure that is of course eligible for AIA, because it's a 3-month period, we only get 3/12 of 1 million as our AIA limit. And that is going to be just £250,000, some £250,000. As this expenditure here was 310,000, we're only going to get the 100% AIA on the first 250,000. But on the remaining balance of 60,000, again, the second of the two enhanced capital allowance figures that we know, there was the first one, the 130%, we now get this first year allowance of 50% here on special rate pool expenditure in excess of the AIA limit. That's 60,000 at 50% is another £30,000. The remaining £30,000, of course, would then go into a special rate pool to be carried forward into the next accounting period, where thereafter, on an annual basis, a 6% writing down allowance would be available on the residue of that expenditure. For this period, hopefully additions are correct, and it's 540,000, and again, up here, and deduct from your trading income. Add to the trading income of the 3-month period the capital gain made, and we have our TTP of 340,000. In relation to our £68,000 deduction of capital allowance from the trading income of 3.2 million, that should give us hopefully 3,132,000 as the tax adjusted trading profit, away from which will come our qualifying charitable donations. They would be deducted, of course, in deriving the total profits, but of course that brings us down to from total profits. It would give us the TTP of £3,112,000, taxed at 19%, and that's going to give us our corporation tax liabilities as we see there. So again, long period of account. How long is the period? Split into 12 months, balance of months. They define the accounting periods, the corporate tax computations. Set those columns up, if it's a Section C question, on the right-hand side of your computer page, as it were, there. The adjusted trading profit, you may have to do that for yourself with the add-backs of the non-allowable expenses and the exclusion of any income that is not trading income. That figure then, time apportioned, again on the assumption that it accrues evenly. Separate capital allowance computations for each accounting period. Note that second period that as it's 3 months, remember to time apportion any WDA that might otherwise have been available, or of course as here, the AIA limit. Allocate capital gains as we've done there. If you have property income or interest income, then we work that on an accruals basis. What was accrued in the 12-month period, what was accrued in the 3-month period. Take away the donations on a paid basis, get your TTP and tax at your standard set rate of 19%, and you have your corporation tax liabilities computed. Okay, so we should now be able to prepare a corporate tax computation from any statement of profit or loss provided by the examiner on whatever length of period it may be, whether it is just a year end or whether it's short or whether it's long. Here the long period is the more interesting one because it's 2 corporate tax computations from 1 period of account. What we've said is it's a statement of profit or loss that was being adjusted. So what we've seen at the moment is profits in terms of your trading performance. What we'll look at in our next chapter together is what happens when we have losses, most specifically trading losses. What relief will be available? And all of that awaits us in our next sessions on our next chapter together.